So you really have to care about enterprise software. What makes buyers ultimately purchase software? What are the nuances of that? Not every company should be a venture backable company. But when you invest, I think it's important to understand your role as an investor and what you should be doing and not be doing with founders. You are someone who is very numbers driven, need that data, then very early stage investing, let's say especially seed, you can sit on the sidelines, but unless you invest, it's your deal, you build conviction, you feel responsible for it, you have the relationship with the founders, you're not really doing venture, right? A lot of the value we bring is just around understanding your go-to-market and unlocking growth. And I think the more you try to run the company, then almost surely that investment is not going to work out.
You've got to give your piece of advice. You've got to obviously share your insights and take a step back.
Yeah.
And get comfortable knowing that it's not your company at the end of the day.
Yeah.
You have some ownership in it, but it's largely run by the founder.
One of the best traits that a founder can have is sort of constant and consistent communication. Some of the best founders, they run experiments very fast. I know you're growing fast, you need to hire, but don't put time pressure on yourself because that forces you into suboptimal decisions. There are very few people who can really do the 0 to 1.
What I think the best founders should do, even if they're not successful from that stint, is... Hi there, everybody. This is the Desi podcast, and I'm your host, Akash Bhat. On this show, we have leading investors and founders who come and talk to us about some of the lessons that they've had investing in the best companies and the founders who have uncovered all the great insights scaling successful organizations over the course of their careers. Today with me on the show is Arun Penmetsa. He is one of the partners at Storm Ventures, an early-stage B2B enterprise-focused fund primarily investing out of the Silicon Valley office. Arun is somebody who's no stranger to enterprise investing. He started off as an enterprise operator, first at Google and then at Oracle, and today has backed a number of companies over the last 10 years at Storm. Some of the notable investments that he's made during his time at Storm include Airgap, Spine, Valview, Hyperproof, Dasera, and many more. We sat down with him today to discuss 3 things. First, how does an investor get into venture capital? What are some of the things that they need to keep in mind as they're picking the right VC fund? Second, we talked to him about everything that he's learned working closely with some of the portfolio companies that Storm has invested in. What are things that they've done really well? What are things that they could have done better? And things that they should have avoided, in his opinion. And lastly, we get his thoughts and advice on what best founders should do if they're trying to enter the US market from an outside market perspective. If you're a founder who's sitting out of India and you're trying to figure out whether the US is the right market, how do you navigate the challenges with respect to hiring people, the marketing strategies, figuring out the messaging, then this is the episode for you. Because he has spent a whole bunch of time in the last segment talking about all of this. This is a fantastic episode for anybody who wants to understand how investors here in the US think about companies as they're scaling to this country. So I hope we can uncover all of these insights for you over the course of the next 60 minutes. Without further ado, here is my conversation with Arun. Arun, welcome to the Desi podcast.
Thank you for having me. It's a great pleasure to be here.
I've been looking forward to this conversation for a while. And there are so many ways that we can start this conversation. But one of the most important questions that I end up asking every investor is, what's the motivation behind getting into venture? Because for everybody, it's a personal story. And a lot of people do it after a stint being an operator. Some of them are founders. Some of them have just been pure investors all their careers. And each one have had a very interesting journey that kind of led them down this path. What's that been like for you?
Yeah, of course. So I was born and raised in India. I came to the US for undergrad many years ago. I would say I have a relatively traditional engineering background, undergrad and master's in engineering, and then I worked for about 5 years. And so I would say getting into venture was half planned, half just serendipity. When I went to business school after working in engineering for a few years, I happened to meet a lot of investors on campus. And I was always interested in investing to a certain extent because my parents in India have been investors for many years. This is more private capital and not really focused as much on software, but sort of physical industries. So healthcare, pharma, now defense and things like that. So when I met a lot of the investors here in Silicon Valley, I reached out through the Stanford network, just trying to understand what that looks like. And I spent the summer at Storm in between the 2 years at business school, and that eventually led to a full-time role. So there was always that interest, but I don't want to say like it was carefully planned out. And I was fortunate to have the benefit of that network to get into venture.
What about venture from the outset is very interesting to somebody who's, perhaps motivated to learn a little bit more about the space and then understand the craft that one needs to have to become a really good investor?
Yeah. I think there's a few aspects to it. One is you need to be passionate about the space you're investing in, right? And I can give you a bigger background on Storm, but we focus on investing in early stage B2B companies. So you really have to care about enterprise software, right? What makes buyers ultimately purchase software? What are the nuances of that? So I think that's the number one thing. You should always invest in areas that you're passionate about because you will, research more and try to understand how the businesses work. I think second is just curiosity. I mean, one of the benefits of living in a place like Silicon Valley is we are kind of at the forefront of so many innovations. And things are constantly changing, and there's a massive amount of information that you have access to and people that you have access to.
Yeah.
So in that sense, it's really helpful if you are curious, trying to learn things, and just kind of, charting your own path in some sense. The third aspect of this is just understanding the role that venture plays, right? Not every company should be a venture backable company. When you invest, I think it's important to understand your role as an investor and what you should be doing and potentially not be doing with founders, and kind of figure out your style. Like, are you a very active hands-on investor? Are there certain stages that you really care about? What are the kind of founders you want to work with? That's three. I'll mention a few other things which are learnings to me along the way.
Yeah.
While venture is from the outside seems very interesting, kind of a sexy category. You get to hang out with great folks. You have to understand it's a very long game, and I'm sure other people have mentioned this on the show. But you often don't know whether you're a good investor or your investments how they're going to turn out for many years. And this comes with cycles too. There could be cycles like we had 3 or 4 years ago where you get quick markups and it sounds like you're able to pick the best companies, and then you have sort of downturns, right, where a lot of your portfolio may struggle. So that is something to bear in mind. The feedback loops tend to be very long, and if you're used to getting quick results or very specific outcomes, it may be hard because oftentimes things are just uncertain. Even when you invest very early, you can have a thesis and build conviction, but you just don't know, frankly. Yeah. There's very little information. And the last thing I'll mention, and we can dig into any of these, is one of the things I didn't appreciate before getting into venture was just the context switching that happens daily in the job, between meeting new companies, portfolios, and you can, over the course of whatever, 8, 9, 10 hours, you can meet half a dozen companies from different industries, different stages, obviously different founders. And you need to be able to, assimilate information and be thoughtful in all those conversations.
Right.
So that is something I definitely didn't appreciate before getting into venture.
No, you talked about 3 things there, which I think can become the theme for the rest of the conversation. First, I want to discuss with you what goes into picking the right fund for oneself as they're thinking about a career in venture. Second, I want to touch upon the dichotomy between an investor turned operator and operator turned investor, and what that kind of like feels like when you're playing that role. And third, we can go into specifics around having that patience in the game and trying to like really understand what venture requires from every person in that role, because I think it's very different for every fund. It's very different as the markets change as well. So let's touch upon the first thing.
Yeah.
When you were thinking about getting into venture and you had that opportunity to do that internship at Storm, and then you stepped out, what were some of the thoughts in your head with respect to, hey, this is the kind of fund that I want to associate myself with. What is the decision-making process one needs to keep in mind? I'll tell you where that question's coming from as well. A bunch of my listeners also want to get into venture capital at some point, or they're thinking about, hey, is this the fund that I think I can build the next 5-10 years of my career in?
Right.
A lot of them are current investors as well. How should one be thinking about their career in venture and what that really signifies for them over the course of the next 5, 10, or perhaps the entirety of their careers?
Yeah, so I'll repeat one of the points I made earlier, which is first, the fund has to really align with your interests, right? If you're a consumer investor, obviously don't go to a B2B focused fund, right? It also has to align with the stage you're interested in. As we briefly discussed, early stage investing, the kind of information you look for is quite different than late stage, where you probably just have access to more financial information, market information, company performance information on which to make decisions on. Early stage investing tends to also be a lot about relationships and building thesis before things become clear, right? You're taking more risks, and then generally your portfolio is broader. So also you need to be the kind of person who is okay with, having limited information, and things are ambiguous, you don't really know, but you have to build conviction in those areas. So I think it depends a lot on the personality of the person and what they feel comfortable doing. If you are someone who is very numbers driven and need that data to make a decision, which is completely a valid approach, then very early stage investing, let's say especially seed, is going to be tough for you. So I think that is the first kind of decision you need to make. Second, I think you have to think about the kind of structure of the fund. There are smaller funds, there are larger funds, both in terms of fund size, in terms of capital, but also the team. So are you sort of a person who wants to be part of a large team, or are you sort of the person who will thrive in a small team environment where you're, I don't want to say lone wolf, but you have less sort of support and resources around you? So I think that's the second consideration. For me, I wasn't recruiting with a bunch of firms. I think Storm kind of happened because I interned there, and that led to the full-time role. But one of the things I really liked about Storm was the small team, right? And they were doing B2B, which is where my background was. They had...
Why is a small team important?
So I think for me, building relationships is important. So when you have a small team, you get to know each other. I think you understand each other's strengths and weaknesses. And even today, like after being at Storm for 10 years, the team is very collaborative. It's not like it's your deal and you run the entire process. Oftentimes when we invest, there are multiple people on the team who look at a deal. And there's obviously a lead who's supposed to do most of the work, and eventually if you invest, kind of manages that investment. But the goal of the investment team is to really make sure that the person leading the deal has built enough conviction. So they push the lead, but it is very collaborative. I also tell my founders, by the way, if you need to reach out to anyone at Storm, you're free to reach out directly. It does not have to go through me. I don't need to be a blocker.
Right.
So we often have this relationship where our founders know multiple partners, and they interact with them, ask for advice, and when Storm comes on the cap table, we do mean the entire firm. And I think building that level of comfort is only happens when you've spent enough time with your partners. And I'm sure other firms do this too, but even today, every Monday before the partner meeting, the entire team, the investment team, the finance folks, the operations folks, all of us have lunch together. Every Thursday, some of the partners have breakfast together. So we spend a lot of time outside of just pure work getting to know each other. And for me, building that relationship, especially if I plan to spend 10, 15, 30 years, as you said, was important. The second aspect of that, I think, is just mentorship. Even when I did my internship, it was very clear to me that the partners were willing to invest time and sort of teach me the venture craft, right? Because I had an engineering background, and at business school, I'd taken some finance classes, but I had never really done investing. So they spent a lot of time with me, walking me through their thesis, doing diligence calls together in the early days, taking me to some of their board meetings of the boards that they were on. And in many ways, I do think, even though there are other ways to succeed, it's really an apprenticeship game. Venture is. So that again mattered to me because it would help me grow without me having to figure everything out.
Yeah.
So these are some things I think people should think about.
How long does it take one to truly understand what is required of an investor? Like, you obviously shadowed, some people on the team.
Yeah.
There's always that urge to bring your own personality at some point
Yeah.
and really start taking ownership. But you also at the same time want to understand what is the language of the firm.
Right.
What does the firm stand, represent? And there's a little bit of onboarding period that kind of like goes in.
Yeah.
And I've noticed, and this is from personal experience as well, when I was at the fund, I was always itching to like, hey, when can I jump in? When can I contribute? When can I really make that early mark?
Yeah.
But sometimes, as you mentioned, venture is not a sprint, it's a marathon. So it's better if you take a little bit more time to understand how people talk about the fund, what value the partners are bringing to the table, shadow them for a little bit. But when do you really fly away from the nest? When do you really start doing that on your own?
Yeah, so there's no one answer, obviously. It just really depends on the fund, the kind of companies you're looking at. Sometimes a great opportunity may come in very early when you're there. I think part of it then comes down to the culture of the firm, where they are mentoring you, but they encourage you to go find your own deals, take more active role within companies that we've already invested in as well.
Yeah.
So I don't think there's one answer here, but I think it is important to be as independent as possible, as early as possible, because you can sit on the sidelines, but unless you invest, it's your deal, you build conviction, you feel responsible for it, you have the relationship with the founders, you're not really doing venture, right? I mean, yes, there's all, because if it's somebody else's deal, there's always a safety net.
Yeah.
Right? Because if things go wrong, it's never fully your responsibility. There's somebody else who originally led that deal. So if you're new to a fund, it again depends on the fund culture. But so for me, what I had done was I did a couple of seed deals, even though typically we don't do that many seeds, as sort of a starting point, because the check sizes were smaller. I could build relationships. There was a little bit less pressure. But honestly, like your first 2 or 3 deals, you feel enormous pressure because it's the first time you're doing a deal. Yeah. You want to make sure it's right. But yeah, I mean, I don't think there's one answer to your question, but the more you push yourself to be independent and start investing and building thesis for your own deals that you own, that's really the only way you would ever learn how to be an investor.
And when did you discover your own personal style, and what is your personal style of being an investor?
Yeah.
Both from a diligence perspective, support perspective, and perhaps externally showcasing yourself as on behalf of the fund.
Yeah. So I think maybe just starting on support, the way I typically interact with my founders is I'm available really anytime. In fact, with most of my founders, I have sort of standing calls, and I usually just text them if something comes up, and I encourage them to just text me.
Yeah.
Right. And in many cases we have standing calls, but honestly, like if there's nothing coming up, the founder can just cancel the calls. And generally what I tell people is just reach out to me with anything. We'll build a cadence over time. But in the early days, especially if it's sort of a relationship we haven't had before, and we kind of build some relationship during diligence as well, but just interact more and more. And obviously I don't want to be too pushy. So oftentimes I tell the founders, listen, the onus is on you. If you want to talk to me like every week or even every day, just text me. I'll always answer, or I'll call you back if I'm tied up. But I find when we make a new investment in the early days, it's helpful to just interact more often, just so that they know where I can be helpful, and I know typically what the cadence should be like. It also varies a little bit based on what the company is doing. If there's a fundraise coming up, we'll interact a lot more because we're planning for it. If there's a major decision point, maybe around go-to-market or strategy, then the interaction tends to be more frequent. We obviously have board meetings, but generally at least my view is, a lot of the decisions and the discussion points should have happened sooner. You don't want to bring up new things that the board wasn't expecting in the board meeting, right? So that's typically the support style. Similarly, I think diligence is a lot of it is just, I think, getting to know the founder, what motivates them, why are they doing this company, especially early, because it's a long journey, it's a very difficult journey, as you know. Um, and and I think I spend a lot of time trying to understand. So there's two aspects. I try to spend a lot of time understanding the motivations of the team. Why are they doing this? Why will they stick through this for the next whatever 10, 15 years if it gets to that? And then two, I also spend a lot of time trying to understand in many ways if we are the right fund for them. Because we can go into this later, but a lot of the time, a lot of the value we bring is just around understanding your go-to-market and unlocking growth, right? Moving the company from that initial founder-led sales to a go-to-market team that can scale predictably and repeatedly. And if we feel we can add value there, then I think we are the right investor. But in some cases, maybe the company is further along, or in some cases, it's a good company, but frankly, it's just very early. Like, we shouldn't be scaling a go-to-market today. So in those cases, also we would pass because we're just capital at that stage, right? Or maybe it's a region of the world that we don't normally have relationships in. So in those cases, we try to figure that out very early in the process.
Let's double tap into that a little bit more.
Yeah.
When you talk about supporting companies from a go-to-market perspective, there are a number of elements that kind of fall into that bucket. It could be hiring the right people that you can help your portfolio founders with.
Yeah.
It's the playbook that you perhaps have seen play out with either an existing company or there's experience on the team previously having done that themselves.
Yeah.
In the third case, it could be just great market insights into new geographies that maybe the team has not really had experience in. And a good example that, as we were discussing before we jumped onto the recording, was, hey, the founders have found a product market fit in maybe a small segment. Let's take India for that matter. But we know that the larger chunk of the revenue is probably going to come from the Western markets.
Right.
So that's where you guys probably have a little bit more geographic-centric insights into how best to sell into a country like the US. Where and how does one start to fit in when they're thinking about, are we the best fit for this founder and this founding team and eventually hopefully this company?
So it's a mix of all of them. Storm's been around for 24 years now, and we've done over 250 B2B investments in that time frame. So there's a pretty extensive network that we have of previous founders, executives, and others. So to the extent the company needs support from a personnel standpoint, we have people we can bring in as well. I would say the most time I spend with my companies, especially in the early days, is just really trying to figure out their go-to-market. So a simple example could be, it's an early stage company. It is the founders selling as they should, right? And many times we tell, your first 20 customers or maybe $1 million ARR, these are just rough numbers. You really need to sell as founders because you need to understand, what sort of the urgency of the problem that you're solving for, who's potentially the right buyer, even though it can evolve. What do you say in these meetings that get people to jump to the next stage, right? And then the question is, how do you take that, almost download that from the founder's brain and give it to an average AE to go execute? Because that is a very difficult challenge. And even in our portfolio, we see companies struggle a lot with that. Because a lot of times, conventional wisdom, and this is changing, is, all right, I have whatever, $1 million ARR. Okay, I go raise an A round, go to hire a VP of sales, spend a bunch of money on marketing, and we're kind of off to the races, right? But that almost never works as well as you would expect. So in those cases, we are really working with the founders to understand, okay, are you building your pipeline properly? Do you have the right signals and wow factors in your first, second, third, fourth meetings to make sure you consistently convert those stages? When you land a customer, do you have the right ROI to make your champion look like a star? And if I had to sort of break down some of the go-to-market insights we have, and this is oversimplifying, a lot of time we spend just trying to understand the urgency of the pain point. Like, is this truly like a problem they need to solve today as opposed to 12 months from now? And then we spend a lot of time with buyers, CIOs, CTOs, CISOs, whoever, to understand what their motivations are in buying this product. Because this is probably an obvious statement, but when you sell a product, yes, you are the ultimate PO is, it's coming from a company, but there's someone within the company who's buying it, someone who is potentially taking a chance on an early stage startup, someone who's potentially risking their reputation by saying, all right, I'll get this startup in. So we spend a lot of time with those folks to understand their and part of the go-to-market sort of playbook is, how does your product ultimately impact them? Because one of the best things your product can do is, if it leads to them succeeding in their career or getting promoted, I mean, you will be sticky and those people will be your champions and they'll take you from company to company.
Right.
So a lot of it is these insights that we built over the years, and we actually have playbooks and spreadsheets and frameworks that we walk our companies through. And oftentimes it's I think it's very intuitive to the founders because they've been doing it, but it's not documented. So that's where the jump comes from. How do you give that to an AE? And the AE looks at this playbook and, okay, that makes sense. If this question comes up, I can say this. And that playbook can be sector specific, customer size specific, or region specific. So the last point you mentioned, which is, company doing very well in India, and the Indian buyers may have a certain view on the market, or they only pay certain ACVs, or the go-to-market may be, a certain style, but the product is ultimately built for a global business, right? So how do you take that and go sell to a Fortune 500 company in the US, right? So the playbook is often different because the buyer persona is different, even though the product is the same. The way they define the ROI, the way they think about the urgency of the pain point, what do you say in that first meeting, second meeting, slightly differs. So when you start moving from, let's say, India to the US, I think we help our founders kind of build that out.
You also talked about one thing there, which is very interesting, which is bringing leaders who are, part of that advisory, board that you've assembled. These are operators with maybe decades of experience, founders who've been there and done that. And that experience is obviously very helpful for a founder to listen to. But how do you then make sure, or let me take a step back. What does the engagement there look like? Like, how does an operator advisor who's working with Storm advise the portfolio companies?
Yeah.
What is the best playbook that you guys have, discovered years of doing this?
Yeah.
And if there's advice that you're giving out to another fund who's trying to build an advisory network for their own fund, to make sure that they're able to deploy this more efficiently, how would you suggest they go about this?
Yeah. So I would say it's not very structured in our case. We have a huge set of advisors or folks we've known over the years that we do introduce to companies both in diligence and especially in our portfolio. Oftentimes, the engagement going forward is really between the advisor and the founder. And we tell them, listen, if this seems like a good relationship, then we can potentially make room in the round for that advisor to put a small check, or the advisor can just become an advisor and get some shares, right? So we try really not to be too prescriptive there, because ultimately it is about comfort for both parties and the fact that they need to be willing to commit time to spend with each other. Because one of the things that could happen, and it does happen, is the founders have this long list of advisors, and honestly, like, you really don't engage with them that often.
Yeah.
So it's just a great network that you can put on a slide, but they're not adding value, and that's what we want to avoid. The one program that's a little bit deeper at Storm is we have an EIR program, like a lot of funds do. And for us, what EIRs mean is they spend anywhere from 3 to 9 months, let's say, at Storm. They're usually in between gigs and thinking about what's next. And they have full access to everything Storm does. So they come to our partner meetings, they can sit on any of the pitches, and we learn from them, and they learn from us, and they become part of our sort of the Storm family, as we call it. And during those times, they are a lot more engaged with our portfolio. They do webinars, they do one-on-ones with the portfolio to give more direct advice. um, you know, in any form of engagement. So that's more active because they're spending those months at Storm. And frankly, it's really good for us because it gives us a lot of leverage. So at any point, we have 1 or 2 EIRs. So it's almost like you have the Storm investment team, and the investment team is sort of slightly bigger for that period. So that's a little bit more active engagement. But in general, what we try to do is we try to figure out sort of the need at a high level, what the founder needs, and then match them with someone we think is great. But the long-term relationship really comes down to them getting along and them figuring out what the right cadence is.
And during that relationship period where they're trying to like figure out whether they're good fit for one another, how much of a role does Tom play in, intervening when required to like understand whether, getting feedback from the founder, getting feedback from the advisor?
Yeah.
Or do you also play the role of connecting them to 2 or 3 people and then them trying to figure out who amongst those 3 are the best?
Yeah. So generally, if it's for one function, we try to do one at a time because otherwise it gets a little bit noisy. If it's, I don't know, let's say marketing, you need help with marketing. There's probably 3 or 4 people that we send to the founder saying, okay, we know these people, we think highly of them. If you would prefer one based on the background, we can start with that. But here is who we recommend you talk to first.
And this doesn't have to be like sector specific. It's
No.
usually largely B2B or it's mostly B2B.
Yeah, I mean, it could be tied to a specific pain point they may be having. Like, this is maybe a little bit sort of a unique example, but it could be like, oh, this person needs a really good coach, right? It's a first-time founder, and we've known founders who really scaled their companies well, and in our opinion, are really good mentors. So we may pick one and say, talk to them. And if that doesn't seem to work, we may introduce a second one. But generally, we try to avoid sending like a lot of people the founder's way because frankly, they're busy too. And when you have so many meetings, it becomes difficult to figure out what would be the best fit. And also, we don't want to take meetings because of obligation, right?
That's true.
And I tell my founders, like, listen, if this is not working, if it's too many people or our engagement is like too frequent, just let me know. I should do more of this, but for a while, like kept asking founders at the end of the year, hey, do you have any feedback on me or Storm? And try to be very wary of that. Like don't want to, because obviously they have 100 other things to do.
That makes a lot of sense. Now, going back to some of the earlier points that you talked about, the second thing I wanted to touch upon was, we said it obviously takes a lot of time to understand whether you're a good investor or not. The cycles are very long, and sometimes you may feel because of the market dynamics, you may feel you're a great investor, and in a couple of years' time, you may have a quick reality check with what happened in the last 5. That's a good example there. But I'm trying to like understand this from somebody who's moved from an operator side to becoming an investor. And this could either be through some of the examples that you've seen both of the fund or just your colleagues in the industry. Now, because somebody has been a founder, and let's say you've been a pretty successful founder, that's one of the reasons why you eventually become an investor. Otherwise, very few failed founders become investors. So assuming that you've had a very successful outcome, you've perhaps gone through that journey of having repeated wins, with a good cadence. Early stage, you probably hit that $1 million of ARR really quickly. You had some fundraising milestones that you were able to successfully accomplish for the company, and then so on and so forth up until exit. So you've seen success come about almost at regular intervals. Now, if you were to mirror that in the context of venture, it doesn't often happen the same way. You may see a few up rounds. It could be, paper valuations that have gone up, and you get markups on paper. It doesn't really tell you a lot whether the fund has been successful or not. So how have you seen some of the best investors who have been operators mold their persona from that investor side from the operator side to becoming that investor, where they need to perhaps for the very first time in their lives understand the game of patience while they have seen patience play out in a different lens?
The first thing is I think you have to get comfortable with the lack of control, right? When you're an operator, especially a CEO, there are obviously things outside your control, but at some level, you have direct control on what's happening in the business. When you make a decision, things can change, right? Or things will change. You tell your team do A, B, C. I think as an investor, and there's obviously great investors out there, but ultimately it's the founders running the business. And while you can advise and encourage and even in some cases push, I think you'll just have to be comfortable with the fact that once you make the investment, you are kind of on the sidelines, and the train is running on the tracks. So I think that's the first thing is you just need to be, and that's why you have a portfolio, right? That's why you don't have one investment as you are, when you're a founder, everything is focused on the one company. And that's why you have a portfolio. The second thing is what I just said, you have a portfolio. So your time is split among the portfolio. And while you care about each individual company and you should work as hard as you can to make those companies successful, there's a reason you have a portfolio. You need to be making the right decisions in terms of, do I have enough investments in, let's say, certain stages or certain sectors, whatever your strategy may be. That way, the fund is not dependent on a small number of companies to really perform. Now, obviously, there's the venture law and the power law, and some companies will do well. And over time, as your companies mature, you'll get a sense of which ones really have potential and which ones don't. But even then, I think sometimes it's tricky because the best performing companies, while you should spend time and, if you're on the board, there's always things to do, often don't need your help as much as sort of the worst performing ones, right? Because they could really use help. And then it becomes tricky because, a lot of investors have told me over the years, like, and I think they meant this, in trying to be helpful, which is you want to spend time with your best companies because that's where the outsized returns will come. And the companies that are not doing well, I mean, you can spend all your time with them, but it could still go to zero, and it doesn't impact the performance of the fund. Because ultimately, I mean, we have to report to our LPs, right? And I mean, as an LP, like, they don't care no matter how hard I've worked or how many deals I've seen or I spent all this time saving this company. Ultimately, they look at the results at the end of the day. What are our distributions? And that's all that really matters to them. So I think those are aspects that are maybe not evident early on. Because if I'm a very successful operator, you may want to just roll up your sleeves and be like, all right, I'm going to help this company. But you can do that in certain situations where it's impactful, but I think you have to be clear that you are not running this company. And I think the more you try to run the company, then almost surely that investment is not going to work out.
Yeah, that's a very interesting point that you bring up. And I've kind of like heard that from a lot of seasoned investors as well, is you've got to like give your piece of advice. You've got to obviously share your insights and then take a step back.
Yeah.
And get comfortable knowing that it's not your company at the end of the day.
Yeah.
You have some ownership in it, but it's largely run by the founders, and you sometimes live and die by that decision.
Yeah.
But unfortunately or fortunately, you do have vested interest in hoping that company does well.
Yeah.
And gives you that outsized returns that we're talking about. In that process, there's a lot that perhaps you've witnessed over the last 10 years. How have you seen your personality evolve from the early days of you investing at Storm to where you are today?
Yeah. I think there's a couple of areas. One, and I still go through this, which is you kind of live through those highs and lows as well with your founders. Again, because we have a portfolio, it's not at the same level as someone who's invested so much of their time and passion into a single company. But I think in the early days I would like really stress out about every single small change, right? And I think now there's more of a portfolio, so you have a little bit more balanced perspective. And we still get involved with all of our companies, and especially they need our help. We're very, very involved again as a team. I think the second thing is I think you start to appreciate just how long the game is, right? When your early days, this is like a simple example, but like you're expecting this big customer contract and it doesn't come through, right? And you're like, oh man, like, what are we going to do now kind of situation. But you realize this is like a long journey, right? And there's always surprises. The other thing that I think you tend to appreciate is, the relationships we build through this process are things that will carry on even beyond that company, right? Founders, may succeed, which is great. Even if the company doesn't do well, they may go start another company, or they may be a friend for life, right? Which I hope will happen to all the founders we work with. So you're also thinking about what happens beyond this one entity that you are investors in. Um, we've been fortunate to have backed over the years a number of second-time founders, right? They start a company, we invested in them. In some cases, the company did well. In some cases, the company didn't do well. But then they go on to start the next one, and we're investors in them. And the founders have learned through the journey, especially if it was their first company, and the second time around, they're much more prepared for what's coming. Um, so I think you start to appreciate just how long sort of the process is, and I wouldn't say you're more calm when bad news hits you, but I think you just take that into account.
Yeah, that's a very interesting point that you said, which is you've got to take it with a pinch of salt sometimes as well.
Yeah.
You said calm, but then I'm adding pinch of salt there too, because at the end of the day, you realize that you all want one thing at the end.
Yeah.
You want either the founders to have a very good, successful outcome,
Yeah.
or you want that to be a very educational experience for them as well.
Yes.
Because sure, there are many reasons why a company can win. There's many reasons why companies may not be successful.
Yeah.
But hopefully that experience teaches you something along the way. And what I think the best founders should do, even if they're not successful from that stint, is communicate effectively to their investors that they're learning as things go.
Yeah.
It could be unfortunately the wrong market that they've been in. There are things that change within the sentiment changes within that particular market very quickly. That kind of make it very difficult. Or there's an incumbent that's done a really good job, or there's a new entrant that's obviously taken up market share. This is a great example of that took business away from a lot of incumbents and a lot of early stage companies as well who are trying to go after that CSPM market. There's very little that you can do.
Yeah.
Maybe a lot of incumbents who are trying to go after the same customers communicate back to their investors that, hey, these are the things that we weren't able to do successfully, and these guys did it. That learnings can actually give an investor much more confidence when that founder goes back and says, you know what, we're trying to wind up the shop. We'll think what the next steps are. And then maybe they come back in a year's time and they're like, we're building a different company.
That's right.
So it's very important to build that relationship.
Yeah. And I think, the communication point is really important because it's not just in a scenario where things are not working. I think it needs to constantly happen.
Yeah.
Even though it takes time and it can seem like a distraction, the best founders and one of the best traits that a founder can have is sort of constant and consistent communication, not just with your board, but in general, investors and advisors, right? Because as you said, the founders are learning along the way, but at any point they know more about their business than the investors, right? So if you put your thoughts down around what's working, what's not working, what are the patterns we're seeing, this is where we need help with, then I think you can get a lot more help from your investors and advisors as well, because they may have seen a similar pattern. They may have connections into customers you're trying to get to. And I, we encourage all our founders to do that. Like even though it feels like, man, I have like 50 other things to do, and I need to type up this email to investors. It's really a way to engage someone who's already invested in you and on your side, right? Because clearly they're biased towards making you successful.
Yeah.
So I think that's a great point.
Yeah. And, moving that conversation along on similar fronts, especially with respect to, the learnings that you've had with your portfolio companies, I want to switch that a little bit more and understand what have the best performing portfolio companies at Storm done really, really well that you can perhaps share with us so that our founders can, take a leaf out of their playbook and implement. These could be simple things.
Yeah.
As simple as, we talked about communication and being, extremely transparent in terms of how businesses run, metrics, things that have not gone really well internally from a decision-making perspective, to maybe things like bigger stuff, like in playbooks to investing or playbooks to like fundraising, not investing, and playbooks to hiring the right people. So what have you seen and noticed that they've done incredibly well that some of our listeners can take away?
Some of these may be obvious, but I think the number one thing is they've hired really well. And this is probably the most obvious answer, but you can tell when founders are really good at spotting talent, especially for the roles they need. And folks who do that really well, I think they learn quicker. The teams perform better. You can delegate faster, and I'll get to delegation in a second. Um, because a missed hire, I mean, the opportunity cost is very high, right? And I would say that's the number one thing. And oftentimes it helps if you've been, especially in B2B, if you've been an operator for a while, you have your network, you've worked with other people, then it becomes a little bit easier because you know their strengths and weaknesses. Um, the second, I think, as I briefly mentioned, is just delegation. You're building out a team, and if you as the founder are not willing to delegate and give them the responsibility to run with things, then it just becomes hard because there's only so many hours in the day, and if you're trying to do everything, it just doesn't work. So it needs to happen at certain stages, and I think that's one. A third thing I would say is just around decision making, and being able to run experiments. So some of the best founders, they run experiments very fast. We talk about, hey, what's working, what's not working, what should we try? And I think they're conceptually able to design, all right, we need to test for A, B, and C, and this is how we test for A, B, and C. And they're able to test that, whether it's, I mean, obvious things are like, we want to try a new marketing strategy or something like that. But even like pricing changes, or thinking about ROI for customers. Like, how do we measure ROI? Well, let's try this with this set of customers and this with other set of customers. They're able to run experiments very fast. And that gives not just them, but the team a clarity on how do we make decisions. Because if it's just like founder decided to do X, maybe that works for Elon, but like, the vast majority of founders in the world, you can't blindly just, I mean, they won't know, right? It's hard to be that person who will know what the right decision is at any point. Um, so and then I think the last one, maybe potentially an obvious one, is they tend to have very clear North Stars. So as a team grows quickly, and the company, let's say, is doing well, right? So you're scaling quickly. It is very hard to maintain culture because you're hiring a lot of people. Maybe in the initial days, you as the founders were like interviewing everyone. Then there's one level below you. Then there's 2 levels, 3 levels. You're hiring in different regions. Especially, I think this kind of manifested itself during the pandemic when teams went remote. Um, but I think if you have a very clear sort of North Star, and that ties into your culture, then I think there's enormous value to that, because you don't need to be involved in all the decision making at that point. So a lot of it ultimately comes down to people, and just how you execute and iterate quickly.
Yeah, I agree with you. I think with respect to hiring, it's very important for the founders first to like understand who do they want. Like,
Yeah.
it's not the role.
Yeah.
Like, sure, you want your founding engineer, you want your founding AE,
Right.
but it's really the qualities that you really want in that person, and then running a process against it.
Yeah.
In my experience, what I've noticed with early stage founders who are doing it perhaps for the first time is they usually tend to hire for the CV,
Yes.
or hire for the role, as opposed to hiring for the person that you want in the role. And
Yes.
if that aligns well with your culture, your team, how do you want them to like communicate? And that's a very difficult process to run.
Yeah.
You need to have, of course, you'll have your standard tests and assessment reviews, but then that culture round where you really get to know whether this person's just a good performer,
Yeah.
or are they actually a good culture fit.
Right.
You need a bit of both.
Right.
And a good mix of both is actually what really tends to
Yeah.
add value to that team. And that's where they make those initial mistakes. Just because somebody's performed really well at company A doesn't mean that they'll be a very successful person at your company. You need
That's
to
right.
see if they're a good fit from a lot of different perspectives.
That's right.
And for that to happen, you need to sit down as founders and really think about, what is it that you're hiring for?
Yeah. Yeah, I think it's a great point. Yeah, I mean, people tend to hire based on CVs because it's easy, right? It's the first thing you see about the person. It's somewhat quantitative, so you can see and say, okay, they've done ABC, so I assume they're good at ABC. But you're right. I think a lot of it, because the roles evolve so quickly in startups that, again, this is sort of a general statement, but you want to hire for people who are flexible, can learn quickly, take responsibility, things like that. And obviously they need to have the skill set to do the job, otherwise it just doesn't make sense. But I think looking at those soft qualities is it's just hard.
It is.
It's just hard, right?
Yeah.
And the only one of the things that we spend time with our companies is we tell them, listen, like, I know you're growing fast, you need to hire, but don't put time pressure on yourself. I need a person by this month,
Yeah.
or I need a person by the next month, because that forces you into suboptimal decisions. Yes, we need the person soon. We'll work as hard as we can to find that person. But if it takes an extra month, it's okay, right? And I'm not talking about like the standard, I need 12 engineers. Maybe, that's different than especially the executive roles, right? Or leadership roles. So we try our best to like tell founders there's time, right? Unless you're running out of money, that's a different problem. But there is time. Don't artificially try to shorten the process.
Yeah, and in my experience, and we've done this at our company, is we've looked for people, along with obviously being culture fits and everything. We look for people who've been previously, founders themselves in some way.
Yeah.
Like they understand, they've gone through that grind. They know that there's a certain level of expectation that comes with being part of that early team. A lot of people aren't able to like perform with uncertainties around them.
Yeah.
They need structure. And that's unfortunately or fortunately the way that the education system around us is kind of like built us.
Yes.
All along, for the first 15 to 20 years of our lives, somebody has told us that, hey, this is what you're going to expect for the next 6 months.
Yes.
In school, it's about a year. And then when you go to college, it's like, hey, next 6 months, this is the curriculum. This is what we're allowing you to look forward to. And this is how we'll structure these classes. So you've always had that structure around you.
Yeah.
But unfortunately, in startups, when you hit that real world scenario, you don't have that because
That's
everything is changing and breaking on a regular basis. And you're not really meant to, our system has not led you to be successful in that kind of an environment.
That's right.
And it's only when you've perhaps been in that, not to say that many people can't be, of course you can be, but a lot of people are unsuccessful in such kind of scenarios. And not to say that they're not good performers. They will be good performers, maybe at Series A, maybe at Series B.
That's right.
When they have a team, when they have a structure, when they have plans around them.
Yeah.
But you need people who can just be independent, take autonomy, be comfortable with, hey, today we're focusing on this, maybe next week we're focusing on something totally different because we think this is where the pull is.
Right.
1 week is a bad example, but you know what I mean.
Right.
Like in a quarter, it'll be completely different.
Yeah. There are very few people who can really do the 0 to 1.
Yeah.
It's kind of a unique, I shouldn't say unique, but it's a rare sort of skill set.
Yeah. And then you also find the same people sometimes not being a good fit for 1 to 10.
Yeah, they don't grow with, and that's fine, that's their strength. And, we've known people over the years who've done that 0 to 1, then they jump to the next 0 to 1. And that's what gives them the energy every day to go do that, right? And working as part of a mid-size or bigger size company with all the processes and politics is just not a fit, which is fine.
Exactly.
But then there are other people who really thrive in that environment, who can take something that's been figured out and then really scale it.
Yeah.
Right? And so part of, again, you're asking what founders should do is just understanding where those gaps are. Because when someone has helped you in that initial journey, you have a lot of loyalty towards them, right? You're like, oh man, this person was so great. We're growing the company. I want to help them succeed. I can't imagine asking them to leave the company or giving them a different role. And I think that's good. But yeah, the reality is, and sometimes they're just not the right fit for that stage of the company.
I agree. And I usually keep bringing a lot of these comparisons back to like how sports teams are operated.
Yeah.
You have certain managers when we take, let's say, the soccer or football context, American football and soccer in general. You have managers who are able to like take teams that are battling relegation.
Yeah.
And they'll be very successful in, bringing people up and making sure the team is up and they don't get relegated because they've thrived in that environment. And you have people who can build teams from scratch.
Yes.
And then you have people who can sustain those teams because you can build teams from scratch, or maybe you don't really know how to get over the line. And then you have people who have been serial winners who just know how to do that. And
that's right.
How I compare that to the world of startups is you may have founders who are very successful in getting a team from 1 to 10. But then what is required to break that 10 to 100 barrier?
Yeah.
Is maybe you need a seasoned CEO who's been there, done that.
Yeah.
Who knows how every aspect of the business needs to be built.
That's right.
Customers in mind, stakeholders in mind, public perception in mind. And that's also why one of the reasons you see a lot of these companies who go public kind of either switch CEOs or a couple of years before they go public or after they go public, they kind of bring much more stable leadership around them.
Exactly. I mean, the CFO role is a classic example, right? When you're going to go public, typically you want someone who's gone through that process.
Right.
because there's a lot of complexity there, and how do you deal with investors and road shows and all that stuff. So I mean, that is a more in some ways structured thing where you expect a new CFO to come in, even though some CFOs can grow into it.
Yeah.
But but you're right.
Yeah. And, towards the end here, I wanted to talk about the last bit that we touched upon, which is go to market. It's one of the main focuses here on the podcast is trying to really emphasize on what founders need to be thinking about when they're entering the US market. These are founders from India, outside of, maybe the Asia market, or anybody who's thinking about entering the United States. There are several things that they unfortunately get wrong right at the outset.
Mm-hmm.
And one of it, maybe we kind of discussed this previously as well. Use a playbook that's worked in their market,
right,
and that try to replicate that in the US market. It doesn't often work.
Yeah.
If you're a founder, you're putting yourself in the founder's shoes. If you're a founder outside the United States trying to sell to the US, what are some things that you need to keep in mind before you enter the US market?
Yeah. So I think there's a handful of things, and some of this is general advice, so it may not apply to everyone. The first is, do you really want to even be in the US market, right? I think the US market, depending on your sector, can have a lot of different requirements. Maybe it's compliance, maybe it's just the size of the accounts, maybe it's just the competition in the market in the US and how you stack up against that. So like any market, I think you'll need ideally one of the founders or someone in the early team you really trust to spend time here and almost do that 0 to 1 journey, right? I mean, you have the benefit of having the support from, let's say, India, in case this company is based in India, to iterate quickly and so forth, and you're not starting from scratch. But you almost want to do that same analysis to understand, is this a market we need to be in? How do we get our first customer, first 5 customers, 10 customers? Do we get to product market fit here? I think you have to do all that. The second thing, and through that process, I think the second thing is you have to figure out your playbook, because the playbook that worked in, let's say, India or Asia will not necessarily work here. And this includes everything from how do you kind of build pipeline, what's your customer, what do you say in the first meeting, second meeting, how do you make your customers champion successfully, the things we talked about. The third is thinking about your go-to-market style, right? Are you going to be hiring people here? Can your team from India sell? Because honestly, if you can achieve that, the cost savings are enormous.
Right.
But it again depends on your product, right? If it's a sort of a mid-market SaaS product, potentially your team from India inside sales can do it. That also informs your pricing, right? Because if you can do at some level a product-led or a marketing-led or inside sales-led process, you can price your product low, and that may be an easy way to get in. If it is something, let's say, like healthcare, where the sales are more complex and you need people in the US, then that's a different kind of go-to-market and requires a lot more investment. So it's almost like redoing the work you did in another country. There's a little bit less because your product is mature, you have marketing collateral, you have support and all that built out to a certain extent, but you are kind of figuring out that 0 to 1 and seeing what works. I tell founders this all the time, they're like, Arun, we've gotten to like $500,000 in ARR, wherever we want to, jump into the US market. We're hiring someone there. We're going to spend money on marketing. And I tell them, like, why do you think the US is the right market for you? Like just walk me through that logic. Maybe it is. I mean, oftentimes US is the biggest market for most B2B companies, so it's not unusual at all. But just walk me through that logic. And sometimes they just haven't thought about it. They were like, yes, obviously the next natural step. But it's just doing the work you would have normally done and be a bit more prepared to enter the market.
Have you also found some of them to be too soon to enter the US with, let's say, I've noticed this with some of our portfolio companies, is they'll just hire a person in the US and they figure that person's going to do everything for them, as opposed to now you're seeing a lot of the Indian founders in the last 5 to 6 years where they've realized that one of the founders needs to move.
Yeah.
If they're a co-founding team of 2 people, it's usually the CEO who moves to the US.
Right.
Replicate the playbook here, and then hire your first VP of sales.
Yes.
As opposed to just hiring somebody here and putting everything, the onus on them to bring the US customers.
I think I think one of the founders should move here. For the reasons we talked about earlier, right? Is I think you have more credibility. You just know the market and the product better. That passion comes through because you're trying to get your first one or two believers, right? The first one or two customers who will take a chance on you. And we talked about that later, the risk that potentially these champions are taking by bringing in an unproven company into their own company. So you need someone with credibility. They may be like occasionally like an AE or someone who's really good at that 0 to 1. But I think you almost, since you're figuring things out from ground zero, you need someone here. Almost, I think it's very unlikely that you have the founder and then you hire a VP of sales. It again depends on the personality of the VP of sales. Some VPs of sales are that 0 to 1 person where they won't hire anyone. They'll be like, I need to figure this out and then I'll hire people. But obviously, you don't want someone who'll come in and say, oh, I'm going to hire like 4 AEs and try to figure this out. So generally, the advice is, founders come in, try to understand the market, where you should be based, maybe hire one AE, the both of you together, try to sell. And if that's starting to work, then you slowly build out a team here. And again, you have support from everything that's offshore. So it's not like starting from zero.
Right.
But it's very risky to just kind of hire someone, as you said, and just expect it to work.
Completely agree with you on that point. And one final segment within that, this is somewhat related to go-to-market in some sense as well. Let's say you've come to the US, you've kind of like figured out that early pull from customers here. Now you're thinking about perhaps raising a round in, it could be your seed, it could be your Series A. With founders who have largely raised their first round of capital back in their home countries, or in this case, let's say India, and they're trying to raise their first institution round here in the United States, what are some of the common mistakes that they make with respect to like fundraising? Yeah. And this could be generic as well, but more specifically with respect to like Indian founders trying to raise capital here in the US.
Yeah, I think a lot of it has to do with just really proving the viability or showing the viability of the product in the US. While the revenue in, let's say, India or wherever you are is important, a lot of investors tend to discount that because it's a smaller market and we don't know how big those ACVs would be. When you're raising the next round, investors are thinking, okay, can this become a big business in, let's say, the US or maybe Western Europe, like in the sort of the Western world? So I think a lot of your emphasis needs to be on, we've figured out we're on the path to product market fit in the US. We have a number of customers. We've built out the initial go-to-market team. The product has the features that the US customers would want. So I would look at it from that lens: is what is the US business doing, as opposed to, and oftentimes it's good to break out, like this is the US revenue, this is the non-US revenue. How is the pipeline in both sectors? Because if you mix it up and show like the aggregate numbers, it's often hard to figure out exactly where we're investing as an investor and where the investment will go to. Because the expectation would be you're trying to scale your US go-to-market, which is why you're raising money from here. So I think the more easier you make it by breaking out that data, and at some level the next where the investment is going to go, the easier it'll be for investors to make a decision.
That's a good point. I agree with you, especially on segmentation of your revenue.
Yeah.
Especially for founders here at least founders who are trying to like raise capital here in the US. Usually the question that I leave most founders with is, or most VCs on the podcast, is reflecting back on the journey that they've had. You've spent 10 odd years investing here in the Valley, largely investing in companies in the US. What's probably been the biggest change in your investing style in the last 10 years? And who are you as an investor today? And if you were to look back at the outset of your career, what advice would you give a younger Arun?
I think it's a bit of what I said earlier. I think just appreciating just how long the journey is and just spending a lot more time thinking about the relationships was probably the advice. The other thing I would say is just have fun. I mean, it's an amazing opportunity where, if I sort of do my job right, I'm in a room with people who are smarter than me in almost every scenario, right? So just learn as much as you can, and I feel that's one of the great things about venture is you're constantly learning, right? New technologies, meeting amazing people, really getting a glimpse of where the world could go. So yeah, just enjoy the ride.
Nice. This is a great note to end the episode on. Thank you so much for your time.
Yeah, thank you. Thank you for having me. It's been a lot of fun.
Well, unfortunately, that brings us to the end of this particular episode. But if you have stayed with us this far, I'm truly grateful. Thank you from the bottom of my heart. You could have spent the last hour or so doing something totally different, but you chose to be here on our channel and listen to our guests. So I'm hoping that you were able to take something away from listening to them. Now, if you want to keep listening to guests like these and all the insights that they're bringing here on the podcast, I would urge you to go and hit the subscribe button. That way, you will not miss out on any of the future episodes that we bring to you. And while you're at it, it would mean the world to me if you could also like and share it with one or two other people that you think may really enjoy this particular episode. My team and I put in a lot of effort in producing this content, and it would really mean the world to us to have your continued support. Well, lastly, we also run a newsletter on Substack where we take you behind the scenes and share with you all the little tidbits and the fun moments that take place before the recording. So if you're interested in understanding how these episodes were shot or what kind of conversations I have with my guests before they actually start sharing all of their insights, then please make sure that you subscribe to the newsletter. All of the links can be found below in the description. And if you also want the reels and the smaller pieces of content that can meet you on your Instagram channels or on your YouTube shorts, then make sure that you're also able to find a link and subscribe to us over there. Thank you again, and I look forward to seeing you on the next episode.